Welcome to the Deep Dive. Our mission today, it's simple. A fast track, really, to getting you genuinely well-informed on some pretty high-stakes sources. We're pulling together some complex, interconnected issues, everything from housing policy and Fed rates to, well, mass automation affecting jobs, and even the future of robots in your kitchen.
Exactly. We're here to connect the dots for you. And today, there's this underlying story, this kind of tension between efficiency and access.
Efficiency and access. Okay, unpack that a bit.
Well, you see federal policy desperately trying to open doors, right? Increase consumer access to big things like housing. But at the same time, corporate America is rolling out these radical new efficiencies, mostly driven by AI. And these efficiencies, they're fundamentally making stable, well-paid work, well, less accessible. It's this powerful push-pull dynamic that's really shaping your financial future.
Okay, got it. So let's jump right in then with maybe the biggest pressure point for most people, the housing market. I mean, the question on everyone's mind is, should you buy now? Especially since our sources confirmed homeownership actually dipped in 2025. First time in nearly a decade.
Yeah, that dip wasn't exactly a shocker. When you stack up sustained high inflation, soaring house prices, and high mortgage rates, well, you basically build a system that prices out your average first-time buyer. It feels almost intentional sometimes. And one economist we looked at was pretty blunt, said the Fed funds rate is just way too high.
Way too high. And they had a specific fix in mind, didn't they?
They did. They argued for a massive cut. We're talking 200 to 300 basis points.
Wow. Okay, 200 to 300 basis points.
Yeah.
For listeners who maybe don't follow the Fed every single day, what does a cut like that actually mean for the economy, for someone trying to buy a home?
Oh, it's huge. A basis point is just tiny, 1/100th of 1%. So we're talking about cutting the main rate by 2 to 3 full percentage points. That kind of cut would ripple through everything. It would dramatically lower borrowing costs, mortgages, credit cards, business loans, you name it. This expert clearly thinks something that drastic is needed to just, break this affordability crisis we're stuck in.
Right. And while that whole debate about the Fed rate goes on, the big housing agencies, Fannie Mae and Freddie Mac, they're actually making moves now to increase access. We saw several new policies, like allowing rent payments to count for mortgage qualification.
Yes, that's a big one. And also ending the FICO scores sort of monopoly.
Accepting crypto as collateral.
That's right. These are pretty major attempts to, open the gates wider. Let's talk FICO first. For decades, that score was the gatekeeper, right? But the sources point out this basically shut out a lot of good renters, people whose main significant payment was rent, not, credit card debt or car loans. So by ending that FICO monopoly, they're trying to force competition, allow other models that look at things like paying your rent on time or utilities.
Makes sense. And the crypto angle. Accepting cryptocurrency as mortgage collateral, that feels significant. Tells you how fast traditional finance is trying to adapt, maybe.
Or maybe conceding a bit to digital assets, yeah. It definitely signals a shift. They're starting to see certain established crypto holdings, if they meet rules, not just as wild speculation, but as actual solid collateral. But look, these policy fixes are all about boosting demand, helping buyers qualify. They don't really tackle the core supply problem that's driving prices up in the first place.
Okay, and this is where it gets really fascinating. The whole story around home builders. We hear constantly about a crippling housing shortage, right? Yet, the sources mention this absolutely stunning figure. Builders are apparently sitting on over 2 million empty, permitted lots, ready to go. If they have the land, why the holdup? Why aren't they building?
It's a bit of an inventory paradox, isn't it? I mean, builders definitely face pressures. High borrowing costs make starting new projects expensive, no doubt. But what the builders themselves often point to, according to the research, is regulation. Local permitting, slow city approvals, red tape. That stuff can delay construction significantly, sometimes for years. And that waiting game, it makes the whole venture riskier, so it kind of incentivizes them to just sit tight until things look better.
And it's not just that they aren't building enough, it's what they're building, or rather not building. The data shows this huge shift over decades, since the 70s. Builders have basically stopped building smaller starter homes, under 1,400 square feet. They're prioritizing the big 4-bedroom luxury places instead.
Well, the math is simpler, unfortunately. Building a bigger, pricier house on that same lot brings in a much higher profit margin. That helps offset those rising costs, labor, materials, jumping through regulatory hoops. If a builder has to fight through complex zoning just to put up a small starter home, well, they're financially pushed to build the biggest, most expensive thing they can on that land. And the smaller home market, the one crucial for first-time buyers, for affordability, It just gets sacrificed for higher margins.
And we also have to mention, because it was in the sources, the external pressures cited. There's a viewpoint discussed that mass illegal immigration has significantly tightened housing supply, contributing to rising costs and rents, especially in big cities.
Yeah, that argument is presented based on basic supply and demand. If you have more people needing to build enough new homes, especially rentals and starter homes, then the competition for what's already there just heats up. And that pressure pushes up costs for everyone, not just home prices, but rents too.
Right.
So yeah, the housing issue is clearly, it's got a lot of layers. Federal, local, private sector, they all play a part.
Okay, and housing relies on people having jobs, stable jobs. Which brings us neatly, or maybe not so neatly, to the next big disruption, this layoff paradox, the one driven by AI and the corporate push for efficiency. We've seen the headlines, huge cuts. UPS let go 48,000 workers this year. Amazon, anywhere from 14,000 to 30,000. Target cut 1,800.
Okay.
So what's really going on here?
You could frame this as market evolution, but it often comes dressed up as cost consolidation. These aren't always signs of imminent economic doom. Often it's companies getting aggressive about efficiency, trimming budgets, and they often time these announcements late in the year.
Yeah.
The real driver, it's pure competition. Look at Amazon. They heavily automate their warehouses, their logistics. That puts massive pressure on rivals like UPS. UPS then almost has to follow suit, adopt similar automation, cut labor, just to stay competitive on price.
And this time around, unlike maybe past cycles, they're being really explicit that AI is the main driver. We saw that source, Chegg, the education tech company. They didn't really mince words. They flat out blamed new realities of AI for cutting, 45% of their workforce? That wasn't just coded language for missing targets.
Yeah.
No, that direct link is important. But, we should put it in historical context, too. The sources do remind us this kind of creative destruction isn't entirely new. History shows disruptive tech, mechanizing farms in the 1800s, the Industrial Revolution. Computers, it tends to wipe out maybe half the job market every century or so, which sounds terrifying, and it is disruptive in the moment. But the historical pattern usually suggests that completely new, unforeseen job markets eventually emerge to soak up that displaced labor.
But is this time really different? Chegg specifically said AI. In past shifts, like from factory work to service jobs, you could kind of see the replacement jobs coming. Where do the sources say these new jobs are coming from now?
Yeah, that's the tricky part. The consensus in the material we reviewed is less about naming specific industries and more about the types of roles. Things needing like high-level human judgment, ethical oversight, creative problem solving. Jobs where an AI messing up would be catastrophic. But the sources admit there's a time lag. There's real worry about that transition period, especially for people mid-career whose skills are suddenly becoming, automated commodities.
And this push for automation, it's also having this big, maybe unintended consequence for organized labor, for unions. The argument we saw was that automation is basically becoming the financial weapon, the antonym to unionization efforts.
It's an economic calculation, really. Union membership has dropped significantly, right? From 22 million back in 1970 down to about 14.3 million today. It's not just about companies disliking unions, it's colder than that. If the total cost of human labor, including potential disruptions, strikes, wage demands from unions, gets higher than the long-term cost of buying and deploying automation, well, companies are increasingly choosing the automation path. Robots offer predictable costs. They work 24/7. Automation effectively takes labor off the table as a variable cost.
Okay, let's pivot now from labor back to high finance, but connecting again to housing. We need to talk about the potential IPO of Fannie Mae and Freddie Mac. The sources are calling it possibly one of the biggest stock offerings ever.
The scale is just mind-boggling. These two entities, GSCs they're called, government-sponsored enterprises, they oversee something like $8 trillion in assets, $8 trillion. They guarantee or own a huge chunk of the entire U.S. mortgage market. And the discussion in the sources, it points to this IPO maybe happening quite soon, as early as Q1 or Q2 next year.
That feels fast, and they expect to raise, $25 to $30 billion just by selling off about 5% of the stock. Why privatize now? They've been under government control since the 2008 crisis.
Well, the motivation seems twofold. Money and politics. Financially, selling off even a bit lets the government get some capital back, helps stabilize the entities fully. Politically, there's been this long-running desire among many policymakers to just end that government conservatorship completely. The sources suggest that fully privatizing them, putting them back under shareholder control, though still with regulation, is seen as, the final step. Closing the book on the 2008 bailout era. The IPO is how they get there.
But here's what's really fascinating and ties this massive $8 trillion financial machine back to big tech today, is their dependence on the cloud. We found out that the Fannie Freddie U.S. fintech subsidiary, the part that handles something like $2 to $2.5 billion in mortgages every single day, runs almost entirely, nearly 100%, on Amazon Web Services, AWS.
Yeah, that level of concentration risk, it's pretty stark. And apparently after a recent AWS outage, even a brief one, that affected them. The sources say there's now an urgent internal push to change things. Relying on just one provider for something so critical to the U.S. financial system, that's now officially flagged as a safety and soundness concern.
So they're looking to diversify, spread the risk.
Absolutely. They're actively looking at splitting their operations across multiple cloud providers, thinking about Azure, Google Cloud, Oracle, others, just to build in redundancy. Because if the system handling trillions in assets, billions daily, depends on just one cloud platform, and that platform goes down, the ripple effects could be economy-wide. So their goal now isn't just efficiency, it's resilience. It really shows how tangled up traditional finance is now with just a handful of huge tech companies running the cloud.
Okay, finally, let's look at a piece of tech that brings this whole collision of efficiency, automation, and maybe privacy right into your living room. We looked into the X1 Technologies Neo. It's a $20,000 humanoid robot designed to do chores like unload your dishwasher, water your plants.
Yeah, the Neo. Impressive engineering on paper, stands about 5'6" pounds, weighs 66 pounds, runs for maybe 4 hours on a charge. It looks like the peak of convenient home automation, but the sources highlight a really significant and, frankly, kind of staggering privacy issue tied directly to how it works.
The privacy trade-off here seems monumental. It has this thing called expert mode, and to use it, the company needs an actual employee, one ex-employee, to supervise and remotely control the robot inside your house. Using a VR headset? Wait, so a stranger is virtually driving a robot around my kitchen while I'm trying to eat breakfast.
Yeah.
What was the reaction to that detail?
Mostly shock, especially because the company CEO was remarkably blunt about why. His quote right from our material was basically, "If we don't have your data, we can't make the product better." He literally sees this remote human supervision as necessary data gathering to train the AI faster, fix mistakes on the fly. The tech press really jumped on the normalization of, well, physical intrusion into your most private space.
Wow, it really raises the question, doesn't it? How far are we as consumers willing to go? Trading privacy for the ultimate convenience. I mean, we've already kind of normalized things like Alexa listening, Ring cameras watching the porch. This robot feels like a massive leap further, letting a remote stranger physically move around and see inside your actual home.
It feels like the next, maybe deeply alarming frontier. You know, adopting new tech often happens before we fully grasp the privacy side, but this one is just so overt about demanding surveillance. If you want the efficiency of this $20,000 robot helper, the price tag apparently includes having a company employee as a sort of virtual roommate watching your life.
Okay, this has been quite the deep dive, covering some huge forces shaping the financial world. Let's try a quick summary. The housing market. Squeezed by high rates, policy trying but struggling to boost access, and builders just not building enough affordable starter homes. At the same time, AI is turbocharging corporate efficiency, which is shaking up labor relations and pushing even giant financial systems to rethink their reliance on big tech's cloud.
And throughout all this, we've seen that critical thinking is just essential, isn't it? From understanding why houses cost so much to the real impact of automation, and especially questioning the trade-offs demanded by things like that home robot, you really have to grasp the implications before this stuff just becomes part of your daily routine.
Right. So here's a final provocative thought for you to chew on, based on our sources. We saw historical data showing the S&P 500 stock market index has significantly, really significantly outpaced real estate investment returns going all the way back to 1970. Now, given the current struggle, the structural barriers younger generations face just getting into the housing market, high rates, low supply, etc., does this all start to change the very definition of the American dream? Is it shifting away from owning a physical home towards just accumulating financial assets? What value does a place to live and call home truly hold anymore, compared to potentially bigger raw financial gains elsewhere? Something to think about.